Ladies and gentlemen, welcome back to this urgent economic news briefing. Because sometimes the most important market signals are the ones almost nobody dares to talk about. Tonight, we step into a story unfolding beneath the surface, a development that could begin tomorrow, what analysts are informally calling the 8 silver squeeze, linked to tightening year and liquidity conditions as we approach December 26th. If you've sensed something unusual in metals markets, if you've wondered why commercial inventories are thinning while demand metrics flash upward, you are not imagining it. And if you have felt the tension between physical shortages and paper price suppression, you're already closer to the truth than many highly paid analysts. So let's walk through what might be coming, why it matters, and what December's liquidity crunch could mean for a market that historically punishes complacency. When cash becomes scarce across the financial system, everything denominated in dollars begins to shift in valuation, not because fundamentals change overnight, but because liquidity becomes oxygen and markets begin redistributing it in unpredictable ways. While the headlines distract us with interest rate debates and year-end stock rallies, an underreported trend has continued to intensify. Declining registered silver inventories at major exchanges paired with increased industrial offtake. Yet the spot price remains suspiciously calm, almost too calm, as though market participants are waiting for someone else to make the first move. That calm is what makes this moment so charged, because historically, squeezes don't start with fireworks, they begin with silence, hesitation, and mispricing. Now imagine this silence interacting with the annual liquidity cycle. The days leading up to December 26th are notorious for funding pressure treasurers, institutions, funds, and international desks all tighten flows to improve year and balance sheet optics. Dollars become less available not because they disappear, but because they get hoarded. And when cash is hoarded, paper claims on commodities, like silver futures, face stress, particularly if physical holders are less willing to deliver metal at suppressed prices. Is it guaranteed that a squeeze begins tomorrow? No serious analyst would say that with certainty. But could the pressure start to show? Could spreads widen? Could futures divergence with physical premiums grow more visible? Those are the types of movements we historically see when liquidity and scarcity intersect. Here is the hook almost no one is discussing. An 8-year move in silver does not require a global shock. It requires pressure at the margins, where price discovery actually happens. If inventory withdrawal continues, if industrial buyers secure forward supply, if retail demand spikes into low-volume holiday trading, the market may not be positioned to absorb that pressure without repricing. And remember, an 8-of upward shock from current levels represents not a collapse of the dollar, not a hyperinflation scenario, but simply a repricing consistent with tightening supply and seasonal liquidity withdrawal. Movements of this magnitude have happened before. They tend to arrive when expectations are lowest, when volume thins, and when attention is elsewhere. So ask yourself, when was the last time you saw broad conversation about silver heading into late December? Exactly. The silence itself becomes a signal. But this isn't just about metals. It is about the relationship between liquidity and truth, between what markets price and what reality demands. We've watched central banks accumulate gold at record levels. We've watched industrial silver consumption climb with electrification and renewable investment. We've watched bullion dealers impose wait times while futures prices pretend abundance. Something doesn't add up, and historically, such imbalances do not last indefinitely. They correct, often abruptly, and often when liquidity is thinnest. As we close, let me be absolutely clear, this is not a prediction that silver must jump tomorrow, nor an instruction for what anyone should do financially. It is an exploration of conditions that appear aligned for volatility, conditions that deserve attention instead of dismissal. And whether tomorrow marks the beginning of a price correction or merely another quiet step toward it, ignoring the signals has never protected anyone. Markets reward those who pay attention before the headlines arrive. Major exchange vaults have reported steadily shrinking deliverable silver stocks. As more ounces migrate off exchange, toward industrial demand and long-term private storage, market resilience to short squeezes weakens. Reduced availability raises the impact of even modest demand shocks. Industrial consumption growth tightens forward supply expectations. Electrification, solar expansion, and battery technology have sustained elevated industrial silver consumption that competes directly with investment demand. As fabrication outpaces new supply, Forward contracts risk being mispriced, particularly when liquidity constraints meet unmet delivery requirements. Year-end balance sheet management reduces market making flexibility. Banks and funds typically curtail risk exposure to lock in annual reporting metrics, lowering market depth and widening bid-ask spreads. Reduced willingness to supply liquidity makes commodity markets more sensitive to order flow imbalances, increasing the probability of sharp price movements from relatively small transactional impacts. Potential 8 of upside move represents repricing, not crisis. An 8 shift in silver would not require macroeconomic collapse. Rather, it would represent rational revaluation driven by seasonal liquidity compression combined with structural supply constraints. Historically, such repricing events occur during low-volume environments where suppressed market signals finally demand correction. Seasonal liquidity tightening is one of the least discussed yet most powerful forces shaping short-term price dynamics in metals markets, and silver may be standing directly in its path. As the financial calendar approaches late December, institutional behavior shifts dramatically, credit lines are reduced, borrowing becomes more conservative, and internal capital is redirected to meet reporting requirements rather than to provide market liquidity. The result is a subtle but pivotal contraction in available dollars, and when dollars become scarce, assets priced in those dollars often behave in ways that catch the inattentive off guard. Here lies the first hook that few are watching. Thin liquidity doesn't merely reduce activity, it magnifies the impact of every transaction, turning what would normally be routine order flow into price-setting events. As banks and funds retreat into balance sheet preservation mode, interbank funding channels tighten, and repo markets exhibit cautious behavior. This seasonal pullback limits the flexibility of traders who normally arbitrage differences between physical silver and paper instruments, leaving short-term pricing less defended. When the same contraction collides with historically low stocks of registered physical silver, the market risks reaching a condition where price is no longer anchored to fundamentals alone, but to liquidity itself. And unlike supply and demand, forces that move gradually, liquidity can change with speed that markets fail to anticipate. If liquidity is oxygen, then December is the season when traders learn how thin the air really is. Investors who view silver purely as a commodity miss the deeper truth. Silver's short-term behavior is financial before it is industrial, and financial variables respond first to liquidity pressures. When fewer institutions are willing to extend capital toward futures positions or arbitrage opportunities, gaps in market making appear. Prices may start drifting. Not because the world suddenly needs more metal, but because fewer hands are willing to hold the rope tight. This is where the squeeze narrative gains credibility, not through conspiracy, but through mechanics. A market with thinning liquidity and thinning inventory becomes a market where price can shift violently from marginal moves. There is a pattern that repeats every time financial attention thins, markets stop reflecting consensus and start reflecting incentives. End of year liquidity withdrawal incentivizes defense over discovery, caution over correction. And when the market becomes cautious, those positioned early have asymmetric influence. This is why an ATATA repricing event doesn't need noise, it just needs quiet. The setup doesn't require panic. It requires fewer participants, smaller order books, and a catalyst that finally forces someone to pay up for real metal instead of waiting for someone else to take the first step. The question is no longer whether silver has the fundamentals, it is whether the timing of liquidity and scarcity creates the spark before everyone else looks up. The growing divergence between physical silver demand and the restrained movements in paper pricing is not merely a temporary imbalance. It is a structural signal that the market's pricing mechanism is struggling to reconcile reality with representation. On one side of the scale, physical demand continues to rise, industrial manufacturers securing long-term supply, retail investors buying ounces at premiums above spot, refiners reporting delivery delays, and sovereign mints periodically announcing allocation limits. On the other side sits the futures market, where silver is traded as a financial abstraction, contracts written, rolled, and settled with little expectation that the underlying metal will ever leave a vault. This creates a fundamental friction point. How long can paper prices dictate value when the physical world insists on scarcity? That question alone is a hook, and the silence around it signals how few are prepared to confront its implications. Every time a buyer pays a premium to secure physical ounces, instead of relying on futures exposure, they cast a vote of no confidence in the current price discovery system. Yet this vote rarely appears in headlines because it happens outside the boundaries of mainstream reporting. Instead, the market whispers through widening physical premiums and tightening retail supply, while futures charts remain eerily composed. But mispricing does not dissolve simply because it is ignored. Divergence accumulates pressure, and pressure, once ignored long enough, tends to resolve abruptly rather than gradually. The market can only pretend prices are stable for as long as sellers are willing to deliver metal at those prices, and that willingness is waning. Consider the logic facing long-term industrial buyers. If they anticipate constrained supply due to energy transitions, electrification, and rising fabrication demand, why would they trust short-term price suppression to continue indefinitely? Locking in physical inventory now is not speculation. It is insurance against a future in which price finally reflects scarcity. Meanwhile, futures traders reliant on rolling contracts do not experience these frictions directly. They experience volatility, not shortage. This creates a bifurcated ecosystem where physical demand pulls upward and paper inertia holds downward, waiting for a moment when one side's grip finally breaks. The hook that few are watching is not the price itself, but the behavior of those closest to physical supply. When wholesalers hesitate to restock at current spot prices, when refiners lengthen lead times, when premiums widen into liquidity, constrained periods, the market is sending signals that paper cannot indefinitely mute. If futures pricing represents expectation and physical pricing represents necessity, which force ultimately prevails when liquidity tightens and supply refuses to bend, the answer is rarely announced in advance. Instead, one day, a buyer pays more because they must, and the price that once looked stable suddenly looks outdated. Market psychology is often treated like a ghost in economic analysis. Everyone senses it, few truly capture its power. But when the price of silver inches toward an artificial floor and liquidity tightens, as if someone is slowly turning off the financial oxygen, sentiment becomes more than mood, it becomes the engine. We are watching a moment where fear of missing out collides with fear of liquidity collapse, creating a pressure chamber of expectations. The hooks are already embedded in the collective investor mind. What if 8 silver is the last chance? What if the squeeze becomes real before anyone wakes up? These questions do not merely echo in retail forums, they circulate through institutional circles where silence is strategy and positioning is whispered, not broadcast. When liquidity evaporates, information advantage becomes currency, and expectations harden into actions before the public notices anything is happening. In such sensitive conditions, even minor shifts in narratives can trigger outsized reactions. A delayed shipment, a quietly revised reserve estimate, a sudden margin adjustment. These small signals become magnified when traders expect scarcity. And that expectation, once seeded, becomes self-fulfilling. People don't rush to buy because supply is gone, supply begins to disappear because people rush to buy. This feedback loop of psychological pressure is the invisible leverage nobody sees on balance sheets. Historically, the most aggressive metal squeezes were not initiated by physical shortages alone, but by belief in future shortages, belief so strong it pulled forward demand like gravity, collapsing timelines and amplifying price movements beyond fundamental triggers. Investors begin to act as if tomorrow's scarcity is today's certainty, and markets respond accordingly. Institutional players know this dance intimately, which is why they position quietly in advance. They understand that sentiment is not just noise, it is the fuse. And once lit, liquidity cannot extinguish the fire fast enough. If the public expectation converges around an $8 floor with upside pressure, what happens when speculative capital starts probing that threshold? Testing whether the ceiling is truly capped or merely psychological. Hooks sharpen further. Is someone suppressing the price, or is someone accumulating? If accumulation is silent, what does silence really mean? These questions spark demand not just for metal, but for answers, and in crisis conditions, answers often lag behind price movements. What captures attention now is not just price, but timing. December's liquidity thinning adds urgency to expectation, nudging participants to act before others do. The smart money rarely waits for headlines, it reacts to the whispers before the crowd hears the roar. And as sentiment converges around the unspoken belief that an underpriced asset may soon correct sharply, markets can shift in a heartbeat, not because fundamentals changed, but because belief became action. When liquidity begins to drain from the system, metals that are normally treated as passive hedges suddenly turn into active battlegrounds. And nowhere is this more evident than in silver's quiet linkage to collateral demand. Just beneath the surface of everyday trading, silver plays a subtle yet critical role in balance sheet engineering, warehouse financing, and over-the-counter collateral swaps. It is not declared as loudly as gold, yet its utility as a liquidity buffer becomes painfully apparent when markets tighten. The moment financial institutions begin rationing cash and brokers increase margin requirements, the hunt for high-quality collateral intensifies. And here's the hook no one wants to say too loudly: in a liquidity crunch, underpriced hard assets become collateral magnets. Those who already control them gain leverage. Those who do not are forced to buy under pressure, not preference. This is why the current environment feels like the calm before a collision, because collateral dynamics shift quietly, invisibly, then suddenly all at once. When cash becomes expensive, institutions start substituting, rehypothecating, and redistributing anything with stable store of value perception. Silver, particularly in bulk industrial bars, becomes more than a commodity. It becomes a ticket into the liquidity pool. The tighter the pool, the more valuable that ticket becomes. Suddenly, what was ignored becomes indispensable. And the irony is irresistible: the very asset dismissed as volatile becomes the one demanded for stability when everything else starts shaking. Investors who recognize this early are not simply holding a metal, they are holding optionality when others scramble for access. Historically, liquidity crunches have turned hard assets into bargaining chips. Warehouse receipts that sat idle become negotiable instruments. Refiners who once sold forward now hesitate, sensing that physical inventory may command a premium not because demand surges, but because financing locks up. This creates a chain reaction: tighter liquidity increases collateral demand. Increased collateral demand absorbs physical supply. Absorbed supply feeds scarcity narratives. Scarcity narratives ignite speculative interest. Speculative interest drives further accumulation. And suddenly the collateral that was once abundant becomes scarce by behavioral mechanics alone. The market doesn't wait for scarcity to be proven. It reacts the moment scarcity feels possible. Right now, institutional positioning hints that collateral stress could amplify silver's strategic value far faster than retail sentiment anticipates. The quiet accumulation of physical reserves, the thinning of reported warehouse stocks, the subtle compression of leasing terms, each of these signals reveals that silver is migrating from speculative commodity toward liquidity instrument. And here lies the hook that could shape the coming weeks. If a liquidity crisis forces institutions to convert abstract balances into tangible collateral, silver's role shifts from optional to